Good morning. This is the Daily Intelligence Briefing for March 11th, 2026.
All right, here's our operational roadmap for today. We're kicking things off with India's LPG supply crisis, then moving to a macro and governance update, followed by a corporate intelligence scan. After that, we'll dive into the Editorial Digest and wrap up with a market snapshot. Let's get right into it.
Okay, let's start with our lead story. Right now, India is grappling with its most immediate stress point, a growing and serious disruption in its LPG and gas supplies.
So, what's at the heart of the problem? Well, the conflict that began back on February 28th and the resulting closure of the Strait of Hormuz has effectively severed some of our most established fuel routes. Because of this, New Delhi has been forced to step in, redirecting fuel to prioritize household use and protect domestic consumers.
The government's first move? They've ordered domestic refiners to absolutely maximize their LPG output. They're pushing for about a 10% increase in production to try and plug this immediate gap.
But the scale of the shortage is, well, it's immense. Oil marketing companies have identified a shortfall that's equivalent to 40 of those very large gas carriers. Now, they've managed to book 20 so far, but that still means they're on the hunt for another 20 just to meet the country's needs.
And this number really captures the logistical challenge here. Sourcing new cargo from farther-flung suppliers like the US or Norway is just not a quick fix. A single round trip for these massive shipments can take about 2 months. That's a huge delay, especially when supplies are already stretched incredibly thin.
So the bottom line is that the commercial impact is already hitting hard across the country. We're seeing reports of shortages of commercial cooking gas from Kerala all the way over to Kolkata. In Gujarat, industrial gas supply has been slashed by as much as 50%, and this is forcing businesses, particularly restaurants, to do things like limit their menus or even pivot to different technologies like induction cooking just to stay afloat.
All right, let's zoom out and see how this crisis is creating broader shocks. Moving to our macro, politics, and governance section, we've got 4 key updates for you.
First up, that shock in West Asia is feeding directly into prices, and fast. You have to remember, about 20% of global oil supplies pass through the Strait of Hormuz. So, Brent crude has surged 39% in just 9 days. To put that in perspective, that's the sharpest initial jump we've seen in a major oil shock since 1990. And as you'd probably guess, this volatility has spilled right over into the global markets. In the first 9 trading days of the conflict, the MSCI World Index fell by 4%, while here in India, the Sensex dropped about 5% over that same initial period before it started to stabilize a bit.
Next, a pretty extraordinary institutional battle is taking shape in the Lok Sabha, right over the Speaker's chair. The opposition has brought a resolution to remove Speaker Om Birla, citing a lack of neutrality. And Trinamool's Mahua Moitra really framed their case with this statistic, pointing out that nearly half of all opposition suspensions in the last 2 decades have happened under his tenure.
Meanwhile, in a really politically sensitive case, the Supreme Court is intervening in the revision of West Bengal's electoral rolls. The court has indicated that special tribunals should be formed to hear appeals from people who've been excluded, basically stressing that these disputes can't be left to ordinary administrative channels alone.
And our final macro update. Just ahead of elections, the government of Assam carried out what's being described as the state's largest ever single-day direct benefit transfer. A staggering 3,600 crore rupees was dispersed to nearly 40 lakh women under the Arunodaya scheme. It really highlights this increasing convergence of welfare and election campaigning.
Okay, let's pivot and take a look at the corporate sector for our next set of updates.
First up, it looks like India has reopened a narrow door to Chinese capital. The cabinet has partially rolled back that 2020 Press Note 3 regime that had pretty much frozen investment. The new rules now allow for non-controlling beneficial ownership from land border countries of up to 10%. But, and this is key, with very strict conditions, no management control and no board seats. This is a very targeted rules-based easing, not a broad reopening.
Next, we've got a major leadership change at Indigo. Just 3 months after the airline faced those network-wide flight disruptions, CEO Peter Elbers has resigned. Promoter and managing director Rahul Bhatia is stepping in as the interim chief until a successor can be named.
Now, this is a fascinating picture of investor behavior right now, kind of telling 2 different stories. On the one hand, retail investor appetite for equities is still really strong. Inflows into equity mutual funds actually rose 8% in February to nearly 26,000 crore, and that was led by a big surge into mid-cap and small-cap funds.
But then you look at the other side of it, and that rush into defensive assets seems to have cooled off dramatically.
Inflows into gold ETFs, which had skyrocketed to over 24,000 crore in January, just plummeted by 78% in February. So the pattern here suggests that while the appetite for equities is still there, that initial systematic flight to safety has already eased quite a bit.
Okay, let's move into our analysis section and see what the opinion pages are arguing. We've got two key editorials to break down.
The first editorial argues that the U.S.-Israeli war on Iran isn't just costly, it's conceptually incoherent. The core thesis here is that the war was launched without any credible political end state in mind, and that the stated war aims just keep shifting.
The piece points out that Iran's leadership signaled continuity, not collapse, in the immediate aftermath of the conflict. And it lands on this really blunt concluding judgment. The Iranian state is far from collapsing, and the way forward is not more bombing.
The second editorial widens the lens from Hormuz to the broader logic of strategic choke points. Its core thesis uses this impossible trinity framework. The argument is that in today's world, countries can only reliably achieve two of these three things: economic interdependence, economic security, and geopolitical competition.
You can't have all three.
The key takeaway is that this age of weaponized interdependence is here, and it's here to stay. The editorial's prescription is a practical one. Diversify your routes, your suppliers, and your partnerships. And its concluding message is really powerful for the current era. Resilience now matters more than faith in globalization's old assumptions.
And finally, let's wrap things up with our market snapshot, looking at the verified closing numbers.
The BSE Sensex closed at 78,205.98. That's up over 639 points. The NSE Nifty ended the day at 24,261.60, a gain of more than 233 points. In foreign exchange, the rupee strengthened against the US dollar to 91.85 and also against the euro to 106.97. And in commodities, oil is trading at $90.66 a barrel. That concludes today's intelligence briefing. Thank you for joining us.